The average price of Vancouver real estate is down $67,000 in the first 2 weeks of July alone. Hey everyone, and welcome back to the Vancouver Life Real Estate Podcast and YouTube channel. The big headline this week is that we are tracking the average and median sale prices, and they are down, and they're going down quick right now. So much so that the average price of a Vancouver home, GVRD we're talking, is already down $67,000 in just the first 2 weeks of July. Now, we're going to extrapolate this data and get a little further into it to kind of really show you what's going on. We'll do that a bit later in this episode. But for now, we also want to touch on a few of the highlights of what's going on locally and nationally in the housing market. I think we should start with the fact that inventory shortage is really kind of the main driver that's going on right now. So yes, we've seen home sales slow a lot from the Q1 highs peaking in March, but I think the slowdown feels a little bit steeper than it actually is. Based on sort of the function of the strength of the earlier market this year. It's akin to, like, let's say you're cruising on the highway at 150K and you've slowed down to 100. You're still moving very fast, you're still cruising, but it feels quite a bit slower than it was. So that's a little bit of perspective of what's happening here. So while you're hearing a lot of slowdown, do realize things are still quite elevated based on the fact that we had such strong numbers in Q1 and really Q2.
Yeah, I think it's important for us to recognize that a lot of the numbers we have been basing performance against have been in either it was a recovering market last year. I mean, we were in a pandemic market the year before, this time last year. And, it feels like you said, it feels like you're doing 150 miles an hour, at least in March. It felt like we were really flying. And now, things have definitely calmed down, right? I mean, I think if we look, just specifically at where we were in March, I mean, we're down 56% in terms of homes sold in March versus where we are now. We pointed to those indicators back at that time too, knowing that we were at all-time highs. Like the 150 was as fast as you could go, right? That was clocked on the radar at 150. So now coming down to 100, it's like, well, what's going on? Is this a problem? And the answer is no. We need to return to some sort of level of sustainability. And I think you're seeing that not just in the real estate market. I think we're seeing that also in the stock market. But again, that's not something that we'll touch on today. But do note that it's happening in other areas as well, right? And maybe that brings up, we should look at some other areas nationally and kind of talk about that, right? Because I think, when you look at the fact that single family sales, they're the ones that are slowing the most right now. And that's largely based on affordability, right? And so, now we're looking, investors are starting to look at condos, cheaper options, looking in the city as those open up and become a bit more desirable. I think it's important to recognize that rents bottomed out in January, at least in Toronto, and rents are up about 8% since then. So it's not all sad and doom and gloom. It's a matter of perspective and understanding the whole story.
Good point. I think it's really speaks to the vaccine taking effect and provinces and cities opening up. So Toronto, which is still largely locked down, is already seeing a demand for the city core again, as we are here in Vancouver. A lot of people are getting in prior to August, September, because I think people are going to really enjoy their summers. I think September, as far as work conditions go and a work landscape, it's going to start to feel a bit more normal. I know a lot of people are getting those phone calls saying you're coming back to the office right now. Oh, understandably, yeah. People are going to have to, or a lot will want to live near where they work. Hence the rental rates going up. And I think a really big reference there to note is you look at Manhattan, for example. In New York, Manhattan just saw the strongest month of leasing activity dating back to 2008.
Ooh, I don't know that year.
Yeah, exactly. So right. Inventory apparently is cut in half since January. So
Well,
New
and
York, which, sorry to interrupt, largely vacated, it's coming roaring back right now.
yeah, and I think another thing to think about, or at least consider, you've got universities opening up, right? And one of the big things we touched on our last pod is that come September, a lot of these universities are going to open up to foreign students, and the borders are going to open, allowing them to come in, right? So the demand for rental property is likely going to increase. Anecdotally as well, we've got some. Interesting how during the pandemic everybody fled the city and went to the suburbs, right? Um, with school opening up and stuff like that, we've actually got clients that are selling out in the suburbs because they want to go back to school, whether that was pandemic related or some other more motivation, but they're actually selling out of those areas and coming back to the city, which is going to improve rental rates and rental demand. Um, but with that being said, um, rental unit constructions are also at their highest point ever. There's currently 95,000 units that are being built. And, these kind of rental purpose builds can dampen the rental rates over time. But we'll see, right?
Yeah, that number is nationally too, just so we have reference here. That is across Canada. Housing has been a quote unquote, an issue, affordability issue for many years. So to see these kind of numbers being hit, it really does speak to the demand. So they are trying to meet the demand of it here. And even with that, you look to the major cities and you look at what's happened with prices from the investor standpoint. Cash flow is becoming very, very hard. You look to Toronto as an example. Investors, that went 80% loan to value with a fully discounted mortgage, they were averaging about $300 a month positive cash flow just 4 years ago in 2017. These same investors shopping in the same area, they're now cash negative about $300. So there's been a $600 swing in cash flow in just 4 years. And again, This is obviously because the prices are higher, even with the interest rates as low as they are today. And we've seen that here. It's incredibly challenging, and you have to be very creative to cash flow positive in the city, let alone, we used to look to Surrey when it was quite easy to cash flow a few years ago. Then that got pricey. We would put investors more out into the valley. Now, even the valley can be a challenge to find cash flow with your average long-term renter.
And the question I have for this is this going to be an issue that persists? Because if you really think about it, is that a function of real estate affordability, growing, becoming less and less affordable, but the jobs that people are getting paid, their income isn't relating to that, right? So it's difficult for investors to buy, say, a condo downtown and then rent it out for $2,100 a month or something to that effect, or $2,200 a month for a one bed when their mortgage is 25, right? So, is that a disparity in the job market? I think that's, income related, as well as it would be the fact that we've had such a boost in the last, the last year in terms of where price points are, right? So it's got to work itself out in order for it to maintain and become more sustainable. But I think in the short run, what you're going to see is more people now looking to outside markets, right? Markets that were secondary or third on their list, right? So when you consider Vancouver, downtown Vancouver proper, I think if you're considering living there, investing aside, I think that there's probably good equity growth potential there, right? Because I think a lot of new business is coming downtown. That aside, being able to rent it because people are getting paid more, we haven't quite seen that jump yet, right? And that might come. That still might come, but I think it'll take some time. And I think in the meantime, you're going to see people going to, like you said, even further out than Surrey, right? They're going to be looking at, maybe they're going to be starting to look at Edmonton and Calgary and markets that people were not considering before, but are now considering because it's the only affordable place left, and there's lower taxes and there's higher incomes, right? So it could be interesting, very interesting time.
A lot of investors do not want negative cash flow. So you got to think areas like downtown cores, like your Vancouvers and your Torontos. If the average investor runs the numbers and they're like, I don't want to be $500-600 negative per month, they're almost priced out of the city as well. So homeowners are getting priced out and investors are getting priced out.
Yeah.
Interesting
Yeah.
thought. But like you said, Ryan, tertiary markets or even places like Calgary and Edmonton, they are getting very interesting again, right? Like we certainly point a lot of our investors to the island and interior BC and even northeast BC.
Mm-hmm.
Nanaimo on the island is exciting. I've personally bought into Langford, for example, and Victoria's remaining strong as well.
Mm-hmm.
But Calgary and Edmonton, they've seen both those cities combined. They've seen 6 months in a row of record sales. Um,
That's nice to hear for that province. That province has been hurting for like a decade. So
yeah, both Ryan and I have investments in Alberta, so we know the market pretty well. We do track it. So to hear this is a bit exciting because we've been hodling for a bit in that area, and
for a while.
Yeah, but again, they kind of. I never panicked. I think there were still decent renters there, and I mean, you got to think the infrastructure is there, right? They've got the strong demographics. The province has incredibly low taxes. They've got affordable housing.
They do, yeah.
They've got cheap rents, for your home, but also for businesses. The commercial rates there are incredibly low.
Yeah.
So seeing 6 months of record sales, what generally follows that is the price appreciation, which this year, Q1 and Q2, I think they're up. Oh no, sorry, for the last year, those markets are up about 6% on average across the board for your detached, for your condos, etc. So the future of Calgary and Edmonton, I think, look very promising in the next few years. They are transitioning, obviously, out of being oil and gas reliant. They are becoming quite tech focused. And I know investors that are starting to do very well there, and they're starting to look there again, right? Obviously, the difference in a detached price to the rents there, it gets pretty exciting.
Well, also what you can buy if you intend to actually live and move there, what you can get for $1 million in Calgary versus $1 million in Vancouver is substantially different property.
Well, you go 500K and you're going to get a detached home close to the city center.
Yeah, exactly.
That just doesn't exist anywhere here.
No, I mean, I wonder if the days of $1,000 a foot and under are coming to an end here, right?
Yeah, there's a lot of markets that are well into that.
Yeah.
So yeah, I mean, talking about home, let's look at GVRD, right? Because even giving you guys stats once a month, we feel isn't enough. So we track this stuff daily. We're halfway through July, and GVRD is sitting at about 1,600 units sold, on track for probably double that, about 3,200. That alone is 18% less than just last month. And as Ryan touched on, we're about 56% rather lower than the all-time peak just back in March.
But it gets a bit more interesting though.
Yeah. So prices, the price tear that's been happening here. The median price of all homes combined for GVRD is already down $32,000 in the last 2 weeks. That's 4%.
Yeah. Yeah, that's a lot. That's a lot for 1 month.
It's a lot for 2 weeks.
Fair enough. Yeah.
And who knows where that's going to keep going or head. But I mean, you look at average prices. Average prices are already down $67,000 in the last 2 weeks. That's 6% already.
Yeah, that's a lot. But the largest decline is in actually the detached market, which also saw the greatest level of appreciation. So, the swing number seems enormous, but also remember the purchase price is substantially higher than some of the other properties here. But, that's down on average $120,000.
That's big.
Let that sit for a second.
Yeah.
That's a huge decline. That's a big decline.
We are six figures. Now that price down $120,000 on average, that takes us back to February numbers to kind of give you an idea of how long it took to get up to that height. So we're back, about 5 months in pricing.
Well, now, yeah. I think there's some skewing though of the prices here.
Yes.
As there always is, especially in Vancouver, there's some mega homes that if enough of them sell, can really move the numbers in any given month, right? 9 homes at this point have sold over the price of $5 million, right? But when we compare June, for example, there was 43. right? So, when we did talk about in the last pod how we anticipated a slowdown in the summertime, I think it's also important to recognize that slowdown, um, if we're selling a lot less of these, very expensive homes, then yes, we're going to start to see some of these average price swings look tremendously large. And like we talked about at the start, it's going to feel like prices are coming off much faster than they potentially actually are, right? Um, Again, I don't see this persisting all the way through September and October and November. I think that those months are going to have a bit more of a run up again. And again, to the point that we talked about, people are going to refocus. Right now, people are like myself. Last week, I was in Kelowna, right, and it was awesome. And I just, I was not focusing on real estate, and a lot of my clients have decided to go camping and other things, right? So I think that that'll change, but do note that that's a big number, that $120,000 swing, but we do think it's attached to some of the luxury properties, because you're going to see a lot of those headlines coming out in the next little bit. I think there was one by the CBC came out and said, homes over 10 million are up 300% over this time last year. That might be CTV. I can't remember. However, the point being is that data was likely out in early June, and you're hearing about it now, so it's old. And we want to bring some context to that too, because it's just not the case when you use that brush for the whole market, right?
Mm-hmm. Yeah, very, very important data that Ryan's just shared. And really want to kind of hammer that home, that because we're going to see about 60% less high valued homes sell this month, it's why the median and especially the average price is dropping so much. And this kind of lends to why the HPI pricing index, why it exists, because they kind of take those factors into consideration and say, look, okay, yeah, great. This month, the ultra wealthy weren't buying as many homes as they did back in June, but there's still big demand in, let's say, the townhome pricing market. So it'll kind of average out where everything truly sits, and it's a bit better, a bit more accurate of a snapshot of how GVRD is actually operating. So we obviously look at multiple price point data to share with you, but there's a reason why HPI exists, and it's a little bit more kind of accurate of what's happening there. And of course, it kind of excludes the super left and right wing sales that kind of happen here, right? The outliers. So it's all relevant, it's all real numbers, but kind of take all three to base your buying and selling decisions on.
Yeah. And again, if you're thinking of buying or selling, it's contextual, right? So we need to look at the property. It's not just going to be one of these blanket kind of comments that applies to your home, right? Anyways, that aside, Dan, let's talk about the Bank of Canada and the interest rate announcement. More of the same as predicted, I think. It maintained its overnight rate at 0.25% on Wednesday. And effectively, the bank has reiterated that it calls for extraordinary forward guidance in committing to leaving the overnight rate where it is until slack in the economy is absorbed and inflation sustainably returns to a 2% target. We'll see.
Yeah, they're still calling that to happen by their metrics at the second half of next year. Don't forget that used to be the first half of 2023, not so long ago. Mm-hmm. But also big announcement from the BOC here. They are pulling off the gas a little bit more with their QE, and they're only going to be purchasing $2 billion a week of Canadian government bonds. At the height, that was $4 billion per week. Then they tapered to 3. Now they're at 2.
Right.
That's $8 billion a month that they're still pumping into the system here at a time when things are open, employment numbers are within a percent or two of pre-pandemic numbers. I mean, it feels like overkill. We know why they're doing it, but still, it's
we're talking about $100 billion still, right?
A year, yeah.
A year, $100 billion a year. This time, if they consider that they're not going to change rates until this time next year, well, then you're looking at $100 billion that the government is still going to spend in quantitative easing, right? Mm-hmm. that's going to continue to push prices. That's what quantitative easing does. So it's going to continue to put cash into the system. So we'll see what happens with price growth, and that's why I'm not sold that prices are going to continue to drop when we hit September, October, November. They may be slower to come back. They may be quicker to come back. I'm not sure, but I can tell you that as long as the government continues to be pumping in $2 billion a week, it's likely going to grow.
Yeah, and with, we've all seen what's happened with prices in obviously assets, in gas, in lumber, even though that's come back. But they're saying inflation is currently around 3.5%. Their target is 2%, so they're saying this is obviously kind of bouncing back off of the lows of this time last year. Kind of like what happened with home sales, right? You hear these home sales up 100%, 200%, 50%, whatever from last year. Sure, it's coming off of a low base. They're calling it transitionary. Will that remain? We don't know. But again, it still feels like they were too attached to the US. They can't make a move before the Fed. And, they're going to keep pumping money into the system until they can kind of get this thing under control. And again, by their metrics, right? Which we know are quite flawed when we talk about the CPI. Yeah.
And I think also whether or not we're being fed the truth is the other side of it too, right? We usually get the truth too late. So we'll see. The Bank of Canada is still on the side of believing that, higher than normal inflation is temporary, right? And I don't know if that's the case or not when you consider that home prices are up nearly 25% year over year, which seems like, they're saying, well, it's going to come back. Just relax. I don't know. We'll see.
Yeah, home prices nationally are the highest on record right now. They inched up even higher in June. So we are experiencing new records, feels like every single month, and yet they're continuing to pump the system. I think that's about it for us today. Yeah. Thanks again so much for listening and watching. If you're getting some enjoyment, some value out of this thing, we do release these every single Saturday morning. So please subscribe and hit the bell to get notified. Thanks so much, and enjoy your weekend.
See you next week.